Hello and welcome to your Daily 5. My name is Erin Swenlin and I'm from decisionpoint.com. Let's look at the 5 charts that I am paying close attention to as we start this trading week. Before I do start though, I wanted to let you know that you can try decisionpoint.com reports for 2 weeks for free. Just use our coupon code DPTRIAL and the number 2. And that will get you your first 2 weeks free. And you can try out our Decision Point Alert, which is your total market review, and Decision Point Diamonds, where I give you 10 stock picks per week, including ETFs. All right, let's get it started. First, we'll look at the S&P 500, the SPY daily 5-month chart. Well, I have to say it's Monday as I'm recording this, and I'm a bit surprised that we're seeing a pretty decent move to the upside today. But the day is not over. We know that we started the day on Friday up and then finished much lower, made a big bearish engulfing candlestick. So I don't have a lot of high hopes at this point for a rally. We could see a little bit of a pop. Things got a little bit bearish as far as investors were concerned. So maybe we will see a little bit of a pop today. But overall, I'm not thinking that this level of support here at 445 will hold. I would be looking closer to 430. We need a bit of a correction, certainly a pullback at this point. And after breaking from the rising wedge, as expected, we should expect lower prices. So at this point, with my PMO pointing downward, I'm not feeling pretty good about the market right now. I do think we have more downside. And a couple of reasons why. Let's look at the Swenlin trading oscillators and the ITBM and ITVM. All right, as you can see, all of them are in decline. Our Swenlin trading oscillators are our short-term indicators. They have been in decline since really this first market top back up here. We did get a little bit of a move on the upside to them on this move up there to the top of this current bull market. The ITBM and ITVM are also continuing lower. So to me, this shows some very short-term weakness, intermediate-term weakness for sure. These are getting a little oversold, so I will say that. But overall, like I said, it's time for the market to move lower. And I have another chart that will explain why. And that is our Golden Cross Index and our Silver Cross Index chart. These are 2 indicators that we developed that we find to be extraordinarily helpful in determining the bias of the market. The Silver Cross Index, well, let's start with the Golden Cross Index. The Golden Cross Index measures how many stocks have a price of have a 50-day EMA above the 200-day EMA. And that means you have a golden cross. So what we do is we tally up within the index or sector industry group we're looking at, in this case, the index, and we look at how many of the stocks actually have a golden cross. And this gives us a pretty good indication of what the long-term bias is in the market. Now, the Silver Cross Index measures how many stocks have a 20-day EMA above a 50-day EMA. We determine that a 50-day EMA crossover is a silver cross. So the Silver Cross Index tells us how many stocks have a 20-day EMA above the 50-day EMA. And currently that is a really healthy 80%, well, 79%. The big problem here is it has topped in overbought territory. And we've had a bearish shift, which means that the Silver Cross Index crossed below its signal line or had a bearish shift. And that changes the character of this market. And we are looking for more downside simply because this indicator has had this shift in character. The Golden Cross Index looks a little interesting. Oops, let's go back to it. It looks a little interesting because we do have that bottom above the signal line here for the Golden Cross. But the problem we have with the Golden Cross is that this is not going to stay. We're not going to see more Golden Crosses simply because we don't have enough stocks above their 50 and particularly above their 200-day EMA. In order to get a 50-day EMA above a 200-day EMA, price needs to be above both. And currently we have lower percentages of stocks above their 50 and above their 200-day EMAs. So that's a big problem. This indicator is going to start turning down very soon, and that will be bad news for the long term. However, we still have pretty healthy above 50% readings, so all is not lost here, which is why we are kind of giving the market a little bit of time to make its way down. But ultimately, the bias on this chart is very bearish, in my opinion, certainly in the short term. Look at the amount of stocks that have lost the 20-day EMA as support and how many have lost the 50-day EMA as support. These are some really bad numbers here. They're falling below 50% here, at least for the stocks above their 20. So this really does indicate that we're going to see lower prices at this point. So what do we do as far as finding some strength? Well, I'm going to talk about technology, not because it's showing strength, but because it's showing a lot of weakness at this point. If you want to find a sector with some sort of bullish bias, that is energy. And really, it is the only sector out there right now showing a bullish bias. And we would be very careful with getting into anything, and really you might want to be considering to limit your exposure at this point, or at the very least set some stops in case we're correct and the market will move lower. So I wanted to look at what I consider the weakest sector and a place where you might want to consider a hedge. Technology is looking particularly weak. It got really, really overbought. And you can see by the participation numbers under the surface. We're going to look under the hood, as I like to call it. So under the hood, when we look at the prices above the 20, 50, and 200, as far as all of the components in the technology sector, we can see that that has been petering off here. We're losing that participation. It's just coming down below 50% reading now on the percent of stocks above their 20-day EMA. Granted, admittedly, the Golden Cross Index is still on its way up. This tells me that the technology sector isn't in complete disarray. It's going to probably continue to hold this rising trend. There's a possibility, of course, that it will lose that rising trend, just given the fact that we are seeing that deterioration under the surface as far as stocks above their 20, 50, and 200-day EMAs. So this could be a bit of a problem. You can see the OBV is confirming this downtrend that we're getting right now in technology. The PMO, since the top, has been moving lower. The RSI is now in negative territory. There are some problems here under the surface, and we think that this might be your place to go for a hedge. And the hedge that I put forth in Decision Point Diamonds last week was the technology inverse. And this is a leveraged ETF. This is not an investment. This is a trade. This is a hedge. This is not something you're going to buy into, forget about it, and let it ride. This is nothing like that. This is for an active investor. Most of you are very active investors, or you would not be watching your daily 5. So this is one of the areas you could consider as a hedge. And full disclosure, I do have a small position in this particular ETF as my hedge. And here are a couple reasons why. I showed you the weakness on the tech sector chart. Let's look at some of the strength on this inverse ETF. We finally have a rising trend channel here, which is something that we haven't seen really since the decline going in here on this inverse, but we're starting to see some move to the upside. Notice that we have two surges of the PMO above the signal line. That's when you get a bottom above the signal line. So we had two of those. When I posted this for my subscribers, the stochastics were down here, but now they're up above 80, which is good. You want to see them there oscillating. They will stay above there. You can see back here. It's not one of these, stochastics aren't going to just jump up, jump down. A lot of times they're going to oscillate. You want them to oscillate above 80 because that usually means you're going to have some good market movement there or movement in that stock or ETF. And that's what we're seeing right now. So I would say the leveraged technology bear 3 times ETF might be a good place to put a hedge on. Small position, just something to, bolster any exposure you still have left to the market. That's all I have for your Daily 5. Again, my name was Erin Swenlin from decisionpoint.com. Come check us out. Try out our reports. Use our free 2-week trial using that coupon code DPTrial2, and that'll get you 2 free weeks to try us out and check out those reports that we have. That's all I have for you. Thanks for watching, and good luck and good trading.